We have now seen the latest eco data out of the U.S. showing really some downside when it comes to manufacturing and also the non-manufacturing services sector. Will this have an impact on how you make your investment decisions as we see more risks rising?
Yeah, when we look at the risks to the market, it's really in the manufacturing sector. We look at the ISM numbers, both manufacturing index and the services index have been deteriorating, and the manufacturing index in a recession for a while now, but both of those ticking down. Two of the other factors we look at, though, are the labor market and the consumer. And both of those are still positives for the economy. The labor market has been strong, consecutive months of strong numbers, and unemployment number that for September that was the best in 50 years at 3.5%. And 2/3 of our economy in the United States is based on the consumer, and the consumer remains strong as well. That could change with what's happening in the trade talks and the tariffs that hopefully could be avoided later this year that would impact the consumer significantly in December, that were delayed from September 1st. But for now, as we look forward into the fourth quarter, we're looking at what hedges we need to have in place in portfolios for those circumstances. But we have this mixed data. We're constructive on the market for now and keeping those hedges in place.
So tell us about those hedges for those down days then.
So we think that it's important right now. We still like secular growth stories like technology for days like today, and for this late in the bull market. Even though September was good for cyclical stocks, value-oriented stocks, we think secular growth stories, technology are the place to be. But for hedges in your portfolio, there's an opportunity here with the Fed lowering rates, with the markets globally bringing rates down. There's real opportunity in REITs, real estate investment trusts, that have done very good in 2019 and in 2018. They're interest rate sensitive, and the fundamentals in real estate are very good. So a lot of days and weeks and months where we see red in our portfolio, in our stock portfolios, REITs are positive. And REITs as a sector are actually outperforming the S&P 500 this year. Another area that's done well, a good hedge since June, is gold. I'm not particularly a gold bug, but as a hedge in our portfolios for the past 4 months, gold has worked very good as a hedge. And then long duration bonds, with rates continuing to come down, that interest rate sensitivity we've benefited from as well. So those particular hedges, we have a saying, we want to hedge against risk, but not against making money. And those hedges have actually done as well or outperformed the markets, which are still doing well this year in the U.S. And so we can hedge our portfolio, diversify our portfolio, not compromise total return.
David, you point out that markets have been doing well in the US, but I'm just wondering how much of the credit for that can you park at the door of the Fed? And is there a real test coming? And I just want to bring up this chart on the Bloomberg, which shows the share of companies guiding earnings lower, now the highest since 2016. So what are your expectations for when the rubber really hits the road with earnings season?
Well, and that is a concern. We've had 2 quarters of negative earnings growth or earnings contraction. We're looking at a third quarter. Right now, consensus estimates are for negative 4.1% earnings growth or earnings contraction on about 3% revenue growth. That just happens to be about the average beat that we get each quarter in earnings is 4.1%. I don't know that we'll get that this quarter, and we'll end up about flat, but we typically outperform. But either way, we're looking for the fourth quarter earnings and into next year for earnings to improve, and we're always discounting the future. So we may have another quarter of slightly negative earnings growth, maybe flat to slightly positive, but we're looking for earnings to improve as we move into 2020. And as you said, the Fed is on our side. That's really the difference between 2018 and 2019. We almost had a hostile environment of the Fed, certainly in the fourth quarter. Part of the massive sell-off we had, 19.5% for the S&P 500, and this time last year in the fourth quarter of 2018, and that almost like clockwork. When the calendar changed, January 4th, the Fed turned dovish and has been and remains. We've had 2 Fed rate cuts. We expect another one here in October, maybe one more before year end. And that's liquidity for the market. We always say it's questionable about what it means for the economy, but we know it's good for the stock market. Don't fight the Fed. So that's only beneficial for stocks and for bonds.